When you look up at a skyscraper in the financial district at 2 in the morning, there are almost always a few floors still blazing with light against the dark. Most people walking by will glance up and assume the people inside are some kind of extraordinary calculating machines, math prodigies grinding through numbers to keep the economy from falling apart. But here's the thing. What if that light isn't coming from a regular office at all? What if it's coming from an incubator, which sounds a little unsettling, right? An incubator for something far more complex and far darker than your average spreadsheet. Not a place where financial models get built, but a pressure cooker deliberately engineered to rewire your psychology and reshape what power actually means to you. Today's topic, we're going to trace the full psychological arc of a senior finance professional across 10 stages of evolution, starting from the most junior analyst position all the way up to the person orchestrating global capital flows. And the point of this video is not to walk you through dry financial tools. We're here to decode how power actually operates inside the system and what it costs to get there. Because at the highest levels, finance isn't math. It's a brutal game of human psychology. What we're about to explore is not some standard career progression roadmap, the kind you'd see on a LinkedIn job post. Not even close. This is a full cognitive metamorphosis. The core transformation goes like this: from accepting your role as a pure instrument serving the machine, to learning how to manipulate that machine, to eventually becoming the system itself. So let's start at the very beginning, where they enter the industry as fresh graduates, as analysts. And from day one, the experience gets defined by one brutal truth: you are a function, in the literal mathematical sense. At this foundational level, people stop being treated as people. They become data processing machines, working insane hours, pulling all-nighters back to back, just to build valuation models, running DCF models, which stands for discounted cash flow, along with comps. So, what does a DCF actually do? Why does it keep them up all night? Think of it this way. You're trying to buy an orchard. You can't just look at how much fruit is on the trees today and name a price you have to account for what those trees are going to produce down the road. You have to project how much fruit those trees will produce over the next 5, 10, maybe 25 years. Factor in weather risk, disease, market conditions, and then work backwards to figure out what that orchard is worth right now. That's a DCF. You're forecasting a company's future cash flows and discounting them back to present value. We're talking thousands of variables, tens of thousands of micro calculations. It's a massive grinding undertaking. And then there are pitch books, those thick, glossy, soulless sales Bibles that analysts have to build so their bosses can walk into client meetings looking polished. Which means at this stage they have zero power, zero strategic input, and absolutely no voice in front of clients. It's a brutal trade-off. You drain yourself physically, you sacrifice your entire personal life, all in exchange for building a knowledge base. But the real wake-up call only hits once they climb a little higher into the early associate phase. Now they start getting included in client calls and meetings. But included means sitting in the back corner, staying quiet and taking notes. And that's when the first illusion shatters. They're sitting there watching senior people close massive deals. And they realize the deals aren't being decided by their perfect quantitative models. They're being driven by relationships, leverage, and timing. The power dynamics are playing out right in front of them, and they realize they're still watching from the outside. The frustration peaks when they cross into VP Vice President. Now they're finally touching real deals. There's a specific example worth noting: an individual who successfully closed a $340 million refinancing deal, nearly $500 million, and the recognition they got for it, almost nothing. It feels like being the engine of a race car running at full capacity, roaring and burning, launching the car down the track, and then realizing in horror that the steering wheel isn't actually connected to the wheels. It's connected to who the driver knows. Because having extraordinary quantitative skill, being an exceptional function, is just the entry requirement. It keeps the engine from stalling. But to get your hands on the wheel, you have to let go of pure merit-based thinking. The hard lesson: land's contribution doesn't equal recognition or reward. Deals move on trust networks built over years. And this is where things get genuinely interesting, because once they internalize that technical skill alone isn't enough. The individual is forced to step into the light and fight for control. And when they're at the director level, managing deals and personally negotiating fees, they run headfirst into an enormous ethical wall, what you'd call the gray zone. Once you hold real control, you start to feel what leverage actually is. And it's subtle. It plays out across transcontinental flights and closed-door meetings. And with that control comes ethical tests. There's one example that's genuinely chilling: an overpriced acquisition. The first time they come face to face with a real moral compromise. The client is about to massively overpay for an asset. But instead of speaking up, the director stays silent. The deal closes. A massive fee flows into the firm. So was that silence a personal failure? Or was it simply the price of admission through the door marked MD? What's fascinating is how finance systematically recalibrates a person's moral compass. That silence wasn't an accident, it was a loyalty test. By staying quiet, they internalized the industry's standards and placed them above their own judgment. The unspoken rule is clear: if you blow up a deal, because of your conscience, you don't understand how the game is played. The moment they compromise, the system registers it. This person is ready for bigger things. That's the core threshold crossing to managing director. And at the MD level, the rules have completely changed. Access is now power. They stop building models. Their power is direct lines to CEOs and the sovereign wealth fund chiefs. Through that access, they manufacture something called information distance. Asymmetric information advantage is the most potent weapon in the arsenal. It lets them architect billion-dollar deals in a matter of hours. The canonical example here is a $3.8 billion LBO. LBO. Leveraged buyout works like this. Imagine you want to buy a multi-million-dollar mansion, but you don't want to use your own money. You go to the bank, use the mansion you're about to buy as collateral for the loan. You're pledging something you don't own yet. Once the deal closes, you use the rental income from the property to service the debt. You captured the asset with almost nothing down. But at the MD level, they're not buying mansions. They're acquiring entire corporations worth $3.8 billion. At this scale, relationships aren't friendships. They're a structured system of strategic leverage. And once they've mastered leveraging relationships at the MD level, the next move goes further still. They become apex predators, stages 7 through 8. The shift goes from advising on capital allocation to directly deploying capital. They cross into the world of private equity. Why be the advisor when you can be the owner? At this level, they receive something called carry. Carry is the profit share when they use billions to acquire companies, and when this cut can run into the tens of millions. But to earn that carry, they have to control the companies, sit on boards, and shape the lives of thousands of employees. They make decisions that are financially optimal and socially devastating. Mass layoffs, for instance. Pulling the floor out from under thousands of families. But to them, it's not a tragedy. They reframe it in sterile language: optimization. It's like playing a city builder simulation. When you zoom out far enough, people stop being people, they're just pixels on a screen. And that emotional detachment reaches an even more extreme level when they shift into macro investing at hedge funds. At this stage, they move from deal-by-deal thinking to systems-level thinking. They trade on macro structures, currencies, bonds, derivatives. They're no longer acquiring companies. They're betting on entire countries. And they extract enormous returns from macro dislocations. One trade generated $380 million in a single week. $380 million in 1 week. How does a human mind absorb numbers like that without breaking? This is exactly what drives the accelerating emotional detachment. Every outcome gets normalized. The numbness isn't malice. It's what happens when you shift from micro to macro. Their entire lens on the world has been replaced. So, when money is no longer the question and macro volatility has become routine, what's the final endgame? That's when they enter the power network layer, stages 9 and 10. The goal now is to redesign the playing field itself. They gain indirect access to policymakers through LP networks. They operate on long-time horizons through the synthesis of vast information, not a handful of obvious inside tips. They quietly coordinate large-scale capital flows between institutions. Their impact is systemic, no longer transactional. And the pinnacle is the architect level. They are the capital allocators for the entire system. They no longer trade or execute. They design global capital flows. They control allocation across markets, institutions, and jurisdictions. And they operate with extreme concealment through structures like trusts holding companies, or SPVs, special purpose vehicles, essentially invisible black boxes, structures that let them move billions across borders without leaving a single personal footprint. And at this rung, the final realization hits. It was never about the money. It was about understanding and controlling the system itself. Their personal identity shifts from a human being into a node, a junction point inside the architecture of global finance. And here lies the ultimate paradox of supreme power. At the absolute peak of power, they surrender their human identity, entirely becoming an invisible link in an invisible chain. They dominate the world by erasing themselves from it. Why? Because to control a system as vast as global capital, you cannot operate as an individual with a distinct ego or distinct emotions. One person's ego is far too small to bear the weight of the system. You have to fully dissolve into the hidden structure of capital flow. You have to think the way capital thinks, boundless, borderless, and ruthlessly optimizing. To run the network, you have to become the network. And with that, we've traced a staggering arc of evolution, from a function grinding through spreadsheets to trading away moral standing, to discarding emotion as a survival mechanism, to finally becoming a node that architects the flow of global capital. A complete metamorphosis out of humanity and into the machine. And that leaves us with one sharp, uncomfortable question, a question about the nature of control itself. If the people operating global finance at the highest level see themselves as nothing more than emotionless nodes, serving a vast architecture, then who or what is actually in charge? Are human beings running the system, or has the financial system itself generated its own life force, compelling all of us, even its most powerful architects, to serve its endless expansion? That's the thought that might stay with you the next time you glance up at those lights burning through the night above the financial district. Thanks for writing this one out. See you in the next one.